Hi, this is Steve Erdman with EFG Futures Group, LLC and International Futures Group, LLC in Chicago, coming to you with some ideas on the crude oil market. We did a piece on crude oil about 6 weeks ago in the first part of March, and this is more of the same, with the market made some new lows after we did our ideas on March 5th, but I'd like to give you a fresh look at crude oil because we have had a positive close on the crude oil market over that 54.20 area. So I'm going to take you to a weekly crude oil chart right now so you can see exactly what I'm talking about. As you can see, since the beginning of 2015, we've had a nice back and forth basically between $42 and $54, and this is after crude oil has broken from about 107 down to the lows that we made 6 weeks ago at around that $43 area. The low that we made in that time period was taken out on the March 5th, actually the week that I did the last report on crude oil. The low we made that week was 43.58. So what I'd like to suggest now is, with the close that we've had this week and this week's price action, that you take a look at a target for buying crude oil futures or putting on some option strategies, or considering any of the above for a trading strategy that would try to take advantage of an up move in crude oil. As you can see from the chart, our measured target is calculated by taking the high made at 54.20 minus the low at 42.03. That gives it's a $12.21 leg, and if you add that to the 54.24 high we made back several weeks ago, it gives us a target of 66.45. So that's basically what we're looking at trying to achieve in the markets. I mean, there's three different things I'd like to suggest today. Buying futures, there's a large contract, 1,000 barrel contract. The initial margin on that contract is $5,390. The maintenance margin on the big contract is $4,900. E-mini crude futures are half size, so it's a 500 barrel contract, and obviously the initial and maintenance margins are less. $2,695 for initial, $2,450 for maintenance. So one thing I'd suggest is buying dips in futures and risking a close under this breakout point of 54.24, or you could use options. Buy your target. Look at buying out of the money options, and the target right now, as we just suggested, would be around 67 bucks. You can buy $67 calls for approximately $900 a contract, plus commissions and fees, of course. These options expire in 63 days on June 17th. Or you could try to use some of the volatility in the crude oil market right now by incorporating that into your strategy by initiating bull call spreads. Buy at the money calls and sell out of the money calls. So right now, at the money calls would be about a $59 strike. Buy July crude 59 calls, there were approximately $3.30 when we did this piece. And at the same time, you sell July $64 calls and collect $1.40. The net cost of that strategy of the bull call spread would be $1.90. That's again before commissions and fees. So your target on that strategy would be the difference between the strike prices, $5, minus the net cost of $1.90. There is a margin on that position. It's $1,160 initial, $1,062 maintenance, and your ultimate goal on that strategy would be $64. As always, if you're using futures, you have to manage risk. Make sure you use stops, and make sure you're talking to your broker about your different strategies. Good luck.